David says, I have used the simulated CD screen. Oh, I'm sorry. I've used simulated CDs and appreciate the recent seminars. We've done 2 of those. I've also used tools to search for deep in the money covered calls about a month out. Often find 20% protection with 16% annualized return. What's your view of this strategy? Okay. So first things first, for the recent webinar I did, I changed all of my columns in the covered call screen. So quickly, let me go back and we're going to reset to the default columns. So that'll give us back the downside protection, percent return if assigned at midpoint, probability. And what I need is percent if assigned, percent if unchanged annualized. I might add that one. I don't want simple. Percent if assigned, return midpoint. All right, so let me just quickly change the column order. I'm sorry, let me get this cleaned up here. I want this next to the percent if assigned. Okay, and I'll put the percent if unchanged, which is essentially the same for an in the money covered call, but I want those next to each other. Annualized, and I got it reversed, didn't I? Yep. Okay, great. Okay, so let me just refresh my page, folks. Give me 1 second here. There we go. Okay, so David's saying he likes to go deep in the money, 20% protection with 16% annualized return. I don't want to clear everything out. So let me just go to the in the money default. I want to leave some of the stock filters there as well. And I want a downside protection minimum of 20% and an annualized percent if assigned of at least 16%. So targeting 1.3, 1.4% return every 30 days. And we're looking at standard April expiration. Go ahead and submit that. Now this found only 2. And part of the reason why is because of the other criteria where avoiding earnings between now and expiration, maybe some of the price to sales, price to earnings, or maybe even the IV range. Let me up this. We originally set the implied volatility to less than 0.7 to avoid biotechs, pharmaceuticals, other things that can quickly shift if there's a phase 2 or phase 3 trial. I'm going to bump that up to 1. Okay, that gives us 11. That's a much better one. Some things I haven't heard of before in this case. This similarly relates to Gary's question, and I'll address that in just a moment. So all of our downside protections, meaning what? How far the stock can drop before we're technically losing money on the position, are all above 20%. The static return for the Mattel, let's just use the Mattel position. The static return if I'm assigned, buying the stock at 20.98, selling the April 17 strike for 430 at midpoint. Bam, 398 in the money, which means my time value that I'm collecting, the premium that I'm collecting, is the difference of that 398 minus the 430. So we're getting about 32 cents of premium against an investment out of pocket of 1668, or 2% return if assigned for 30 days with 20% downside protection. Very safe strategy here. And then what, of course, David was referring to, I apologize, is the annualized return. If I'm able to get 2% every 35 days, not necessarily on Mattel, but again, on other positions that match this criteria, we'd be looking at a 20.3% annualized return, percent if assigned return. And I'm sorting by downside protection. That's why it's not sorting from highest to lowest. This would be near the highest. Okay, so what do I think of this position? Well, I can just say, David, if it matches your targets and it matches your goals, and you feel confident that you're going to be able to get this consistent 16% annualized return at 1.9% static return for 35 days, this deep in the money with a 20% downside, then you'll probably hit your goals. What can I tell you right now about Mattel? Well, I don't know if it has earnings coming up between now and expiration, but what I can tell you still is that right now, let me go back to home. Now, let me go back to the main home screen. I'm sorry, I should have stayed there. The VIX is still at 20.69. It's not at 35. It's not at 65 that we saw about a year ago. Remember? 90 a year and 10 days, or less than a year and 10 days ago. I'm sorry, 10 days less than a year ago, on around March 20th, I think was the high when the VIX was around 90. Prior to 2018, when we started to see the China trade wars, that first blip in the market, February 5th through February 9th of 2018. And then we saw some other blips, and then we had that disastrous October, hesitant November, very volatile, and then disastrous December going into 2019. The VIX was half. It was at 10. It was at 11. We're still double the volatility in the market that we saw from about 3 years ago, when the market had just come off that 217 run from straight lower left essentially to upper right with some issues before volatility really started to take a hold. Why am I bringing this up? What does this have to do with in the money covered calls? Because I may be wrong, but because the way things are going, and talk about vaccines, talk about things opening back up. We have the new stimulus here. We know we're going to take a look back and say, okay, what did we just do to the deficit in the last 3 years? And that's going to cause some panic in the market, maybe some volatility, David. But with everything opening up, the economy going back to normal, still fear of coronavirus out there, but lessening as more of the vaccines come out and things of that nature, you're going to start to see this. Mattel would be at a 0.35. Craft volatility, implied volatility for their options is one I look at and go back to from time to time, David. Their volatility right now in those options, I think, are around this range, 0.35. They're normally 0.18 to 0.2 in a normal market condition. It's going to take months, maybe even a full year from now before we go back to quote unquote what we might consider a normal market condition, David. But volatility is going to start to drop. And in this case, we're expecting a max return. Again, we saw 32, 33 cents. That gave us your 1.9% return for 33 days. Assuming half the volatility, in this case, it would still be the same, but we wouldn't be getting this price. We wouldn't be getting 430 for this option, believe it or not. This deep in the money, you might only see a third, 10 cents of net credit, 15 cents of net credit, not 30. So in a volatile market right now, David, you can kind of see what I'm saying. If you're finding these positions on a consistent basis right now, and if you're able to achieve that, you'll be getting close to that probably for the next few months. Once volatility starts to decay, once it starts to fall, you're going to be harder pressed to find these positions. Let's see with an expectation of 0.35. Let's go to calculators next to our option. Let's just go to the simple Black-Scholes pricing model and change our volatility down here on this Mattel option to 0.35. And of course, right now it's showing us we're expecting a bid of 430. Let's put in these hypothetical numbers. That's all we're changing. Okay. And it drops down to 4. The expected option price today is $4. Basically almost at intrinsic value, I think. 2 cents off of it, right? So this is the problem. It's not giving you the 1.9, 1.82% return for the 20% annualized yield you're looking for. You're looking at a 0.5% time premium, which was what? 2 or 3 cents. So the downside protection isn't going to be there. Let's take a guess. Not a guess, I'm sorry. Let's take a look. I'm going to save this criteria very quickly. And we're going to call it, 20% downside and 20% annualized. I think you did reverse, but that's okay. 20% annualized. Sorry, folks. So let's go ahead and save that search. Now, I can't do it, can I? I'm sorry. Let me do this real quick. Let me pause the screen. Okay. Sorry about all that. Should have just done it another way. Okay. All right, so here, I'm sorry, here's what I have to do. I have to log out of our webinar account. I have to log onto my personal account. I'm doing that very fast. I apologize. And I'm going to recreate that search on my account. We did the in the money screen. And I wanted less than 1, 20% annual, 16% downside. Was that your numbers, David? I'm sorry. I know you guys aren't seeing this. Just give me 1 second. Okay. Let me lower that down to your correct numbers. 16% annualized return. We looked a little bit higher. That's okay. 20% downside, David. Fantastic. Save this as... All right. Okay. One quick thing. I know, folks, I'm sorry. One quick thing, and we're all good. All right. So, see, does that come back up? There we go. Now, this is on my actual account, and I've saved it as March 12th downside, David. And you see we have the same trades, Sunopta, Tegna, and Mattel, just on a different account. Now I'm going to go to backtest. We're going to go into Smart History Excel. And let's go to September of 2017. Let's just search the day following expiration. Expiration standard is marked by an asterisk, so we'll go to September 18th to look for the October series with our March 12th downside. All right, so this might take a moment. I apologize. Of course, what we're doing right now in the background is we're uploading all of the history for today's close of day data, all the stocks, options, and ETFs. Same criteria, allowing the volatility to go up to 1, annualized return of at least 16%, downside protection of at least 20%. No positions meet our criteria. We might be in an earnings cycle, so let me take out the earnings. Okay, let's see if that helps the position. Nothing. With the same exact criteria, and in 2017 we were in an uptrend, so there are plenty of stocks that are above their SMA 50, have a reasonable broker recommendation, good earnings, price to sales, and so forth, in the price range of 9 to 100. We are seeing nothing that's 1 month out, 20% downside protection, 16% annualized return with the in-the-money covered calls. Why? Because the volatility was too low. Let me take this down to 10%. Okay, plenty of trades. 1.6% return. Oh, I'm sorry, I don't have annualized. Let's add in the annualized percent if assigned. Okay, there you go. Downside protection, percent if assigned, annualized. Let's just add that in. Okay, but I think you kind of see the idea. You're looking at some here that are close to 17, 20, but there are ones that are found, I'm sorry, that have your annualized return greater than 16%. None of them, though, offer the downside protection you're looking for because the volatility was lower. They're not there. Okay, we see some here. The best we can do is probably 13 with a 25%. That's pretty good. 15, 14 with a 22% return. Pretty good. But again, your strategy is working now, David, because of the volatility. I'm just saying that if the market settles, volatility falls, you're not going to be seeing this as frequently. Am I seeing anything wrong with your position? No, I don't see anything wrong with your position and with your approach right now, David, if it's matching your goals. My fear is that you might not reach the annualized return you're looking for over the course of the next 12 months. We may see some hiccups here and there, but honestly, I expect to see a change in volatility where we might not be seeing that ability to get what you're looking for going forward. Okay, and I just, based on what we just saw, going back to 2017, we had to change the values there for the downside protection and that percent return if assigned in order to see it. We weren't seeing the numbers that you were looking for back in 2017 when the volatility was back at its normal levels. Okay, so David, that's my thought on your approach. Again, final words, if it's meeting your goals, it's meeting your targets, and you're finding them now, fantastic. If it's not broken, don't fix it. That being said, I don't know if you're going to expect to see those same kind of returns and those same kind of values going forward into the next year. If you're going to be able to hit that annualized return, because as volatility falls, we're going to expect the returns in the money or out of the money to decline as well. Yeah, and that's a valid point, David says, and I was hinting at that, but I didn't really say it. David says, great review, and thanks for highlighting the extra factors to consider. Volatility required to generate candidates, but also have to consider carefully why an individual stock may have higher volatility and the market as a whole. You're exactly right. If the volatility does creep back up to 28 or 29, that means the future expectation of the market is very choppy, and you'd really want that high downside protection as you're looking for, David, or possibly more with a put protection as opposed to an in-the-money covered call if you're looking to protect stocks that you own that have a realized gain in them or that you've been building up over the last several months and you don't want to give up your gains. That's when you'd use a put. Using an in-the-money covered call could work on those too, but if you get assigned, then you have to give it up and you're out of it. But you're absolutely right. Why do these stocks have the higher implied volatility? 0.9 on Sun Opta, 0.938, 93% on Tegna. I don't even know those two stocks. I used Mattel because it was one of the two I recognized right away, that and ICI Bank. I don't know the Magnachip Semiconductor I've heard of before when I was comparing it against ON Semiconductor a couple years ago. But that's essentially it. I don't know these stocks, and they all have what I'd consider high volatility. And Mattel, and what was the other one that came up? Remember that original restriction was less than 0.7. So there were two results we had, Mattel and the other one, which I don't see here now, for the implied volatility restriction. But those are considered pretty high. Just a standard implied volatility in that case.